This is a very important chart of Lorillard because it shows the point at which Darvas noticed an unusual reaction of volume. It also shows the points B, C, D, E, and F where he purchased stock, and it shows the point G where he sold out for a nice profit on this particular trade. This is very important because it allows us to look at this chart and compare with charts that exist today over 50 years later. Darvas asked for daily quotes on stocks after observing the sudden rise in volume at point A when it began to emerge from the swamp of sinking stocks like a beacon. He bought his first 200 shares of Lorillard at 27.5, that's point B, with very narrow stop loss of $26. A few days later, a sudden drop to C touched off his stop loss. He was sold out. The immediate afterward rise convinced Darvas that his first assessment was correct, that this was a strongly rising stock, and he bought another scale purchase of shares again at 28.75. As the boxes piled up, Darvas bought another 400 shares at 35 and 36.5 at point E. The stock rose rapidly to a new high of 44.3. A sudden drop to a new low of 36.75 on February 18th scared him into raising his stop loss to 36. As Lorillard continued its sensational rise in price and volume, Darvas was strongly tempted to sell for a quick profit. But he adhered to one of his basic principles of his theory. There's no reason to sell a rising stock, and trailed his stop loss at a safe distance behind the rise. I have to wonder with this comment if Darvas studied W.D. Gann's teachings, because this was a central teaching that W.D. Gann had to his students. Now, except for the possibility that with a very close stop loss, he might have been sold out in June when there was a sudden drop to 53.375, Darvas might easily have continued with Lorillard on its phenomenal rise into the 80s at the end of the year. But in May, he became extremely interested in the movements of another stock for which he would need all the capital he could get. It was for that reason that he sold 1,000 shares of Lorillard early in May at 57.375. That's at point G, for a substantial profit of $21,000. He was now ready to invest in E.L. Bruce. This is a chart of E.L. Bruce. There's only one point A that shows the intense volume that he noticed that caught his attention in the first place, and his buy-in point at B on this particular chart. He'd now invested all of his funds in Lorillard and Diners Club. Nicholas noticed point A, a great interest springing up in a stock called E.L. Bruce, a small Memphis firm. While it did not meet his qualifications as to fundamentals, the technical pattern was so compelling that he could not take his eyes off of it. Now, today, we have studies that show that unusual call volume has been shown to tip the hands in pre-announcements of mergers and acquisitions. So Darvas was actually noticing something that's been completely documented today. In fact, virtually all of the things that led to Nicolas Darvas' success have been documented at the highest levels of finance from schools like Harvard and Stanford and the University of Chicago, Oxford, and others at that level. E.L. Bruce showed a phenomenal rise from $18 to $50. This was followed by a reaction to 43.5. But to Nicholas's trained eye, this seemed only a temporary halt, a refueling. Despite the lack of a fundamental reason, he determined to buy as much of it as he could if it went over 50. Fully confident that the rhythm of the advance was there, he sold out Lorillard to have all of his funds available for an immediate investment in Bruce. Within a period of 3 weeks, at the end of March, he bought a total of 2,500 shares at an average price of $52 at point B. His timing, as the chart shows, turned out to be perfect. Bruce began to climb as if drawn upwards by a magnet. It was spectacular. By the time the price reached $77, it was obvious even in faraway India that something fantastic was happening on the American Stock Exchange. And the situation was indeed fantastic. Short sellers operating on the basis of fundamental value were desperately trying to cover their positions. Trading was suspended on the exchange, but Nicholas was offered $100 per share over the counter. Let's discuss how erratic yet strong the relationship between earnings and price advances are. The Investor's Business Daily financial newspaper has a wonderful EPS rating that's extremely useful, but it can be very hard to trust fully, even though I prefer that particular rating to be in the 90s. E.L. Bruce did not have the strongest earnings in the market. I would not be surprised if the EPS rating would have been below 70 if calculated then. It was then that he made one of the most momentous decisions of his life. He refused to sell this advancing stock. A week later, he received share prices averaging $171 for a profit of $295,000. This next chart of Diners Club shows the same important points. Point A, where Darvas notices a volume, buy points B and C, and then sell point D. Although this stock had shown a rising pattern in the first half of 1957, this rise was not marked by an accompanying increase in volume. It was only at A, when after a 2-for-1 split, that there was a sudden sharp jump in volume, that Nicolas became seriously interested in Diners Club. He found that the company was a pioneer in a new field with a definite upward trend in earnings power. Satisfied on this fundamental point, he bought another 500 shares at $24.50. As the stock continued to advance, he followed through with another purchase of 500 shares at 26 1/8 within a few days, at point C. He watched complacently as the pattern of pyramiding boxes developed, accompanied by a tremendous rise in trading volume. As the price rose, so did his stop loss to 27, then to 31. After reaching a new high of 40 1/2, the stock suddenly seemed to Nicolas to have lost its will to rise. It looked as if its last pyramid would hesitate on the brink of going in reverse. It almost seemed ready to tumble. Fearing collapse, Nicolas moved up his stop loss to 36 5/8. In the fourth week of April, the event against which he had insured himself occurred. Diners Club took a dive, and Nicolas sold out at point D with a profit of over $10,000. He had acted on purely technical grounds, completely unaware at the time that American Express was about to enter the credit card field in direct competition with Diners Club. It was the successful timing of this operation that fully confirmed for him the correctness of the technical side of the approach. This is a chart of universal controls. Nicolas noticed unusual volume at point A, bought in at points B, C, and D, and sold out at point E. He writes, a little unknown company called Universal Products caught Nicolas's eye in 1958 after a sudden enormous spurt in volume at point A. This was accompanied by a price rise from below 30. A little unknown company called Universal Products caught Nicolas's eye in July 1958. This was after a sudden enormous spurt in volume at point A that was accompanied by a price rise from below 30 into the $32 to $36 range. In the beginning of August, he made a cautious pilot purchase of 300 shares at 35 1/4. 2 weeks later, as the stock began to firm up, he purchases 1,200 shares at 36 1/2 at point C. Up it went. And days later, he acquired 1,500 more shares at $40 at point D. Shortly afterwards, the company's name was changed to Universal Controls and the stock was split 2-for-1, so that he now held 6,000 shares. In January 1959, Nicolas landed in New York and embarked on a series of operations that came near to ruining him. Fortunately, Universal Controls performed beautifully during this period and gave him not a moment's concern. But in March, something happened to Universal that spelled trouble, and trouble surely came. After a wild 3 weeks rocketing from $66 to $102, it switched its momentum and began to go in the other direction. He didn't like the look of this drop at all. It felt as if an air pocket, and there seemed no sign of a rise. Nicolas acted exactly as he'd done with Diners Club in a similar situation. He raised his stop loss to just below the last closing price and was sold out at point E. Nicolas acted exactly as he'd done with Diners Club in a similar situation. He raised his stop loss to just below the last closing price and was sold out at point E. His prices ranging from 86 1/4 to 89 3/4 were more than 12 points. That's $12 below the high, but he was well content with this. He was very happy. He had had a long, long ride and a profit of $409,000. This is a chart of Thiokol Chemical. He notices unusual volume at point A, buys in at point B, C, and D, and E, and sells out at F. In Tokyo, early in 1958, Nicolas noticed sudden heavy trading in this stock following a 2-for-1 split at A. It remained quiet for some months afterwards, but to Nicolas, his tranquility had a feeling of a calm that precedes the storm. Soon after Darvas started getting daily quotes, Thiokol looked as though it was flexing its muscles for an upward jump from $45. He made a pilot buy of 200 shares at 47 1/4 at point B. For 4 weeks, the stock kept pushing up towards $50, and at point C, just as Darvas felt it was ready to break through, he bought 1,300 shares at 49 7/8. On the heels of this purchase came Thiacol's issuance of stock rights. These rights are very like call options, more commonly used for the same reason today. Back in the 1950s, there was no organized stock option trading as there is today. The exchange that does this is the Chicago Board of Options Exchange. That's the CBOE for short. Rights were more common when Darvas was trading because there was no organized option market. These have been taken over by call options that confer the same advantages with far greater liquidity than rights. In an inspired series of transactions, which are fully explained in the book, Nicolas took maximum advantage of the tremendous credit that is available when rights are exercised. Through the purchase of 72,000 rights and the sale of his first 1,500 shares at 53.5, he acquired 6,000 shares of Thiacol stock at a subscription price of $42 per share when the quoted market price was in the mid-50s. His cash outlay was $111,000 towards a total purchase of $350,000. 3 months later at point D, his broker wired him that he had a profit of $250,000 on his Thiacol investment. As he walked through the streets of Paris, tormented with temptation, every fiber in me, he writes, seemed to be saying, sell, sell, but he held on to the stock. Of course, Darvas never for a moment forgot to move his stop loss up as the stock rose, but with Thiacol, he allowed a greater leeway of movement so as not to risk being stopped out on a short-lived reaction that occurred at point E. The rise which followed, and which continued after the 3-for-1 split at the beginning of May, culminated in a high point of $72 per share. This was accompanied by such hectic trading that the New York Stock Exchange suspended the use of all automatic on-stop and stop-loss buy and sell orders for this stock. This is a chart of Texas Instruments. He noticed unusual volume at A, bought in at points B, C, and D, and sold out at point E. After his sell of Universal Controls, Nicolas took a careful look at the market for an actively traded high-priced stock in which to invest over $500,000. With such a large sum involved, he also had to allow for the possibility that his buying might affect the market. Except for some slightly erratic behavior at the end of 1958, Texas Instruments had been moving steadily upward for over a year. The velocity of its advance had increased coincidentally with a marked rise in volume at point A in October. Nicolas bought 2,000 shares the second week in April at point B at an average price of 94 3/8. The following week, as the stock continued to act well, he acquired another 1,500 shares at 97 7/8. Within a few days, he made a final purchase of 2,000 shares at an average price of 101 7/8. On July 6, Texas Instruments closed at 149.5 at point E, and it is at this point that Darvas takes off from Monte Carlo at the end of Chapter 10, with a new set of adjusted stop losses waiting somewhere below the closing price of his more than $2.25 million worth of holdings. This is a chart of Fairfield camera. He noticed an unusual amount of volume. However, unlike other spikes in volume before, there was a substantial increase in price at point A associated with this punch in volume. Then he buys at points B and C and sells out at point D. The sale of Thiacol left Nicolas with an investment capital of over $1 million. He decided to divide this into two parts. Then he chose 4 stocks that he'd been watching for a long time. They were all suitable as far as my techno-fundamentalist theory was concerned. One of the stocks that survived a test buy to determine the best relative market strength of the 4 was Fairchild Camera. Fairchild had been very stable in 1957 and most of 1958, despite 2 periods of tremendous increases in trading volume. But at the end of 1958, a new jump in volume at point A was complemented by a rapid and almost continuous rise in the price of the stock. At this point, it became interesting to Darvas. He made his pilot purchase of buying 500 shares at $128. That's at point B, when the stock had established itself in a 110-140 box. Having removed the arbitrary 10% stop loss at 115.25, which was too close with respect to the lower limit of the box, he was unaffected by the low of 110.25, which occurred 2 weeks later, 13.87% below entry. On the contrary, the stock reestablished its upward momentum almost immediately. He bought 4,000 additional shares at point C at prices ranging from 123 and a quarter to 127. He held 4,500 shares of Fairfield Camera, along with Zenith Radio and Texas Instrument. Nicolas was now able to sit and do nothing, on the sidelines just keeping vigil while my stocks continued to climb steadily like well-made missiles, he writes. At the end of the book, Fairfield Camera closes at $185 at point D. This is a chart of Zenith Radio. He notices unusual volume with an associated increase in price at point A. Then he buys in at B and sells at C. This is the second of the stocks into which Nicolas switched the capital that Thiokol built for him. It is quite different from Fairchild in its pattern prior to the time of this investment. Peak trading in Zenith at the end of September 1958 was accompanied by an explosive price advance for this already volatile stock. Darvas made his pilot purchase at $104 at point A on a when-issued basis, just after the announcement of a 3-for-1 split. As with Fairchild, he dropped the arbitrary 10% stop loss which he'd set up to eliminate the weakest of the four stocks he was interested in. Had he kept it there, he would have been stopped out the following week when Zenith dropped to $93. However, as the price immediately started an upward move, he scaled in as planned and bought 5,000 shares at prices ranging from 99 and 3/4 to 107.5. Zenith moved along nicely after that, and it is worth noting that though its progress was unspectacular compared to its pre-split rise, the little difference between his average buy price of $104 and the closing price of $124 at point C. On July 6, when the book ends, this represents a profit to Nicolas of more than $100,000. When they were writing up these charts, the editors pointed out to Nicolas that his purchase of Zenith was so late in its rise that it looked anticlimactic. He agreed and said, "By hindsight, it seems to have been late in its rise. At the time, it looked to me like the beginning of a new rise. After all, I only expect to be right half the time."